Hey everybody, this is Mortgage Seth here, and I am very honored to have one of our region's top real estate agents, Shelly Puentes, joining me today with the beautiful backdrop of the Golden Gate Bridge behind her.
Yes.
Today we're going to talk about what's going on in the market, and Shelly's going to start us off with some local statistics for the Tracy and Mountain House area, just to give you an idea of what the current state of the market is here as we go through these crazy times. So take it away, Shelly.
Yeah, thanks, Seth. So yeah, I wanted to look and see what was active, just pending, active, pending, and sold like this last week for the cities that I'll keep an eye on. So for Mountain House, we've got 2 active this week, 2 pending, 1 sold. That one was newer. And then Tracy, we've got 10 active this week, 13 pending, and 12 sold. And let's see, a couple of those in Tracy got 11. One property got 11 offers. That's a lot.
Wow.
And another one got 12 offers. Yeah. And they're all, pretty much on the money with regard to their list price. A couple of them are somewhere in the realm of 3,000 to, we had 1,000, one that was like 10,000 off, but, could have been priced high to begin with. Not that
yeah,
doesn't happen,
I talked
right?
to one agent today. And she told me that her listing went pending within 5 days with multiple offers, and it was 50,000 over. So that's probably not in your stats yet because that one just happened. But
right.
What do you think? What do you think causes that? Is that just people trying to seize the opportunity in this crazy week we're having, or is it priced too low? Or what are your thoughts if you hear that something goes for 50,000 over with this crazy time that we're in?
Yeah, 50,000 over. That's a big chunk. So it's probably my best guess listed on the lower side, and then also could have been also a little bit of demand. I mean, definitely there are buyers out there that were in the market that are looking for a place to live, and there's not a lot on the market right now across the board. So I think it was a combination of things and condition as well.
Okay,
Yeah.
great. So anything else you want to share about what's going on with the housing market and where you see prices going and what's happening with these strange times that we're in? What are your opinions on that?
Yeah, well, I mean, what comes to my mind right now is, from the information that I've been studying, and most of your housing gurus and economists and super smart people, I mean, they're making a correlation between what's happening now and 9/11. And they're not catastrophizing, they're not forecasting that things are going to, ultimately crash. Like I think a lot of buyers are secretly hoping.
Yeah, there'll always be people that think that there's a crash coming. And we've been hearing that for how many years? I mean, ever since 2008, everybody's been saying they're waiting for the next crash so they can get a bargain because that's what the experience was the last time. But for these kinds of cycles in the market and external factors that affect our housing prices, there's a lot more that goes into it than just some economic condition or some outside condition, medical condition in this case, that affects the market and prices. So I feel the same way as you. I think it's laughable that there is a crash coming. We may see some ups and downs like we do from season to season, but overall I don't think anybody's going to benefit by waiting, just like people who said that 5 years ago saw what happened as we got to this point. So yeah, I agree with you there.
I mean, I would say right now, you got to use common sense, right? Hey, if you have to buy, you have to sell, you have a need coming up, do it, Now, if that's different than if you just want to kind of maybe sort of, if you could find something, your perfect unicorn house, maybe now isn't the time. I don't know. Maybe it is the time. It just really depends. But for people that need to buy, people that need to sell, it's been great to see, I know I'm set up to do virtual listings using Zoom, FaceTime, sellers can show me the inside of their house, DocuSign the paperwork to them. They can actually take their own pictures. Usually I like to take professional pictures, but I can coach them through and they can send me pictures. So I can get a home listed and
Yeah,
or
that's great.
make the showings contingent on, seeing the interior of the property or really long close of escrow.
Yeah, definitely. And I think that, during these times when people say they're going to wait to either list their house or wait to buy, the interesting part of it is it just pushes that demand, kicks the can down the road, right? So all these people that are waiting, they're going to realize at some point they don't need to wait anymore, and the market's going to continue to balance that out with what the demand is and the supply. So yeah, we'll see what happens, but I don't think there's all this doom and gloom that a lot of people are talking about. With the situation that we're in right now, it is definitely terrible. There's an impact on so many people. People are losing their jobs. The unemployment numbers came out that were the biggest we've seen in a long, long time. So there is a downturn in the economy coming, but what most people try to relate together is a downturn in the economy and the effect that has on housing. So it's two different things, and they do affect each other, but you have to take in all the other factors that are out there. So
and now, who is losing their jobs? Like, I mean, it's mostly people that are having face-to-face contact with people, right?
Well, it's a lot of people, that are in the service industries, right? Restaurants are already having to close down. They're talking about the stimulus to try to keep those businesses propped up. But if you don't have any customers coming to your business that relies on foot traffic or restaurants, these kinds of things, then there's going to be a pretty quick impact. These cycles are quick on meeting payroll and being able to get inventory in the door. So all these factors those are the people that are losing their jobs right now. Fortunately, in mortgage and real estate, we're a little more insulated from that. But the overall economy that is driven by the service sectors and production sectors, people are really affected if they can't go into work because of whatever reason.
Right. And so I think Mountain House is fortunate, the Tracy area. I mean, we have so many people that are still able to just work from home versus not work at all. Right.
Yeah, I think, that's a good point. The types of people that are living in our area and the types of jobs that the majority of the people have out here is really they're essential people. A lot of law enforcement, a lot of people that working at either the national labs or the school systems. All these kinds of jobs that are deemed essential that still are doing the work that they need to do, whether or not they have to go in or they're adjusting to work from home. And the other part of it is, even if they're not an essential kind of job, then they can work from home. A lot of tech workers and those kind of things that they're adjusting and adapting to this new style that we have. And my hope is that one of the longer term effects is that our traffic will be reduced when businesses realize they don't need everybody to come in at the same time every day. And they can adjust some things. I'm hoping that'll be one of the silver linings as we come through all this, that there'll be a rethinking of the commute situation, but you never know. We'll see what happens.
Absolutely. That would be fantastic. So let's talk about the market. I started out in this business as a mortgage broker. So this is the housing, what's going on with the Fed and the mortgage-backed securities. And I know the charts have been going up and down crazy, huge, wild swings. Me and you have been talking about this daily. So let's go ahead and try to, let's talk about it maybe and make it a little more relatable to just, our neighbors.
Sure. I'm gonna share my screen a little bit here so we can talk about what's happening in the markets. Can you see this the screen that I have shared here?
Yeah. Hopefully my phone does not. I need to plug into my phone. So I'm going to put you on speakerphone.
Okay, perfect. I'll go through some of these charts, and this is the main chart that I look at every day, which really gives us an indication of what's been happening in the mortgage markets. The time frame I have on here is just from the first part of this year, January through today, and these small blips that you see here. This is our normal market move from day to day. These small increments that go up and down, and we see different trends for what's happening with rates. This is the cost of the mortgage bond, so it's actually the opposite of what rates are doing. As the green means that rates are moving in a good direction and they're getting lower, basically. But just to give you an idea of what these swings are, up until this is basically the St. Patrick's Day a couple weeks ago on the 17th is when we saw the lowest rates in history. And this little triangle here is where I was locking people in. And that was the low point that we hit, where everybody was talking about rates being at their lowest point ever. And then we saw, you know, these giant swings where a whole month of gains or losses were changed day by day. So that's something that's really interesting to look at here. And that's continued to happen every day, that we've had these huge swings. And the impact that that has on rates is that at the beginning of the day, rates may be 3.5%, for example, and then by the end of the day, they're approaching 4% on these days where you see these big red candles on the chart here. So it's really wreaking havoc on what's going on. And there's a couple of factors that go into this, not to get too technical. I made a couple of videos that are on YouTube that talk about what the Fed's move to 0% means for mortgage rates. You can check that out. It sheds a little light on how they're related, but they're not the same thing. So we'll never see a 0% mortgage rate, just for all of you waiting for that. And, you know, looking at this chart, we see that the rates today have been moving again in a positive direction, but the volume that we got from when we saw the dip come all the way down, that was really having an impact on what the banks can handle now. So all the refinancing that came in when we did hit that low point, when we were seeing rates at 3% or lower, there was the demand for refinancing of about a year's worth of volume within 1 month. So, I mean, just to talk about the numbers, there's about $1 trillion that are out there that get done in refinances a year, I think. I don't even know what the number is, but it's some huge number. And then we saw that number come in basically a month of people trying to get locked in for refinancing. And then we got hit with the coronavirus and the shutdown of everything and the reworking of people's job situations, my ops staff all working from home, you know, just adjusting things right during this tremendous amount of volume. And the impact that that's had is something we've never really seen before. The banks and the investors are actually raising their rates to slow down the demand. And that's why, even though we're seeing our pricing improve and we should be seeing mortgage rates go down a little bit, they're being held at an artificially high point where we should see rates at 3% right now, but they're really holding around 4% so that banks can catch up with all this volume. And they're doing things like adding points where we're never used to seeing points on a lot of these loans. That's another way that they're trying to discourage and slow down this refinancing. So I've got, you know, everybody that's calling me after they heard the news that rates were at their lowest. Well, that was a couple weeks ago, and we can wait and see what happens again. So I've got everybody kind of waiting in a queue for the refinancing. As far as the purchasing goes, you know, that's still strong. The purchase contracts that are coming in, like you talked about, there's still transactions happening, and we're able to handle those. They get a priority over refinances, but the perspective on that is changing. People are saying, oh, I should have this super low rate, and what the reality of it is that, you know, the product in these transactions isn't the mortgage. The product is the house. The mortgage is the tool to get there. You can always refinance later, do what it takes to get into the house. That's kind of how I've been coaching people when they say they want some super low rate that isn't available because things are changing so fast. You know, maybe it'll come back, but the most important thing is to be able to get the house. Are you okay there, Shelly? Did you fall under the bridge?
I had to. Can you hear me okay?
I can hear you great. I was afraid you got
stuck I had to get some notes. No, I was totally totally following you there, you know, and that made me think of a couple other things. So I thought I had to get some notes. But so what a lot of people don't understand, two things. I had a couple interesting conversations today. Like the one thing I've had conversations with people is this concept of, you know, artificial capacity, right? And how, you know, once the lenders get through their pipeline, you know, then what are they gonna do? The rate sheets are gonna come down low so they can get some more refinances and purchases in their pipeline. And then they're gonna, you know, artificially raise them again once they get too much so they can deal with what's in their pipeline. So I hear people saying a lot of times, oh, well, I'm just gonna wait and, you know, I wanna refinance or whatever, but I'll just, you know, I'll get my paperwork in whenever. They're not understanding the sense of urgency, because when the banks reduce their rates, you know, to fill up their pipelines again, you know, then the people that are gonna get locked at those rates are the ones that have their applications in. By the time you hear rates are low, and then you call your mortgage bank broker and you have that conversation to figure out what loan program you want, and you get your W-2 uploaded, and then you have technical difficulties, the capacity's gone and the rates are back up again, right?
Yeah, and these big swings that we have every day, I mean, if you miss the opportunity, you may have to wait a few more weeks. So you're exactly right. I had people in that same situation. I had a group of people that I could get locked in when the time was right, and a group of people that I didn't have, ready because they didn't give me what I needed, or they couldn't make a decision, or they were waiting for it to go lower or whatever. It's just like the stock market. When we see an opportunity, you have to act on it, and you have to make your decision, and you can't regret these changes that are happening from week to week. People will be, if rates were going the other direction and I locked people in, people would be saying, oh, now I know rates are lower, can I get a lower rate? And the answer is no. We've locked you in, and we did the best we could on whatever date it was, but the market's moving fast. Just like, if you invested in a stock and it was 30%, you're kind of stuck with that. That's the way that it goes. So that's the perspective on that.
More complicated than it sounds also, because it's not like that, you don't just want to give a lower rate, but when you lock a loan for 30 days, like that lender has basically reserved that amount of money for you, right? That's why we have lock extensions. That's why if you take longer, you get a 30-day rate lock. You can't lock your loan within that 30 days. You got to pay like an eighth more to get like a day or 3 days, right? Because the lender has used that money. They've promised you that money, and they promised to give it to you within the 30 days, right? And so, if the rate goes down, I mean, it's just, if they relock you at a lower rate, there's going to be a cost for that, right? Because on the back end, the lender has made, they've calculated, their margin and stuff on the money at the rate that they promised it to you. So if you float down, they're going to charge you more for that. You'll get that other rate, but a lot of people don't understand, why am I paying a cost? Because it's not just as simple on the surface. You got to if you have an understanding of what's happening on the lender side with regard to the warehouse lines and where they're getting the money from, then it becomes a little, more understandable. But most people, your everyday person, doesn't understand that, right?
Right. I mean, there's a lot of, kind of insider knowledge. It's not just most people that don't understand it. It's everybody. 99.9% of the people that are even in the business don't understand what's going on in the background with how lenders have to cover their margins on locked loans and commitments that are made. Right now we're shifting to 60-day locks because there's so much volatility in the market that if we can't deliver on those loans within the time that we lock, then there's a lot of risk there, and a lot of companies are at risk of going out of business from not hedging properly and not meeting the commitments that they have to investors and the warehouse lines, like you're talking about, the creditors. There's big margin calls that are happening, 8-figure margin calls that are happening from mortgage companies that when rates are changing so fast, margins are called on these warehouse lines that somebody's got to pay up to make whole the changes that have happened in a short amount of time. So that's, a lot of detail that people don't need to follow or need to know, but it's interesting to talk about so that people kind of have an idea of how complex this gets behind the scenes. It's not just, me deciding on a rate that I'm going to give you someday so I can, charge a certain amount or whatever. All that's regulated with how compensation works and how banks get paid. But the changes that are there day to day and the risk that's happening in the market right now, it's just, it's a lot to understand. And you and I are fortunate we have these gurus in the marketplace that we could follow. Barry Habib is the name that always comes up. He's the guy that's on Fox Business and CNBC, and he's been doing this for 20 plus years. He always gets this crystal ball award for predicting what's going to happen in the markets, and he calls a lot of this, and he's the one that I rely on to help understand where the markets are going, when to lock, when not to lock, where there's opportunities, and to really get to the root of what's happening in the background. So yeah, there's a lot that goes into it, is the short answer, but and that's, people in the business, that's our job to understand that and to help the consumers get the best deal. But there's, a lot of pressure on us when things are changing so quickly to try to help people understand what's going on and make sure that we're doing what we need to do. Yeah.
Pressure, and so forbearances.
Yeah, so I'm glad you brought that up.
I mean, everybody, let's talk about that. I mean, we all can, if we've had an economic hardship, we can forbear, not make our mortgage payment. That's a fancy word for forbearance, for anywhere from 1 to 12 months, right? You got to call your lender, blah, blah, blah. Now, call your servicer, who's different than your lender, but call your servicer and arrange it. You can't just not make your mortgage payment. Now, the thing is that when we do forbearance and any missed payments, they're going to go on the end of our mortgage, which is fine, you know, but in the meantime, you're talking about stress. I mean, it's not like, so the servicer, the servicer is still paying on those however many hundreds of thousands of mortgage payments are for forbearance, for miss, however you want to say it. They're still paying on that.
Yeah, so that's a great risk that's happening right now in the industry. And that's another thing that's keeping these rates high and causing lenders to add on points so that they can, make the money that they need to make to stay in business. So, let's take an extreme example like Quicken Loans. They've been buying up all the servicing on all these mortgages. They're a huge operation. And what happens if people stop making their payments, then they're still on the line as the servicer with these billions of dollars of mortgages that they don't have money coming in, but they have to pay the investors that actually own those mortgage bonds, that own those mortgages. So if people stop making their payments for 3 or 6 months and you multiply that times the millions of people that they have in their system, that's a huge burden. And without a government bailout, I think that they're going to be at risk of bankruptcy, of not being able to meet their obligations and going out of business, which is really an interesting thing. They've become this behemoth in the industry, and that's just one example. So think about, people in the middle or on the smaller business side, the stress that's there in the servicing industry, and that does have a big impact on rates. There's this risk. Servicers and lenders have to hedge their risk of loans getting paid off early and losing out on that monthly stream of cash flow, which is another thing that goes into this. But back to the forbearance discussion, if people aren't making their payments, then somebody's on the hook for actually paying the investors that own those notes that need to get paid as part of the commitment, or there's going to be businesses that go under if they can't meet those obligations. So that's an important thing. Forbearance is different than forgiveness. So that's a good way that you put it. All the payments have to get made at some point, and the thing. There's all this talk and hype, of course, and you need to rely on your local professionals in your market to help you understand what that means for where you are. But what's happening with the discussion of forbearance, that's not only impacting where rates are and what lenders need to charge, but it's also making people think that they just don't have to make their payments. So I'm glad you brought up, talk to your servicer, talk to the lender, call your loan officer, find out what the procedure is, because if you don't document it properly, then you can't get into these programs. And you're going to pay for it some way. Either the money's getting added on in the back end, which is increasing your loan amount, which is making you pay more interest, or if you don't get accepted into one of these programs because you can't prove a hardship, you're not really affected by losing a job or something like that, you're just trying to take some months off, then it could affect your credit as well if you don't make those payments and you're not in a program.
You need it, great, use it, but if you can make your mortgage payment, like you said, it's for forgiveness. So, let's make our mortgage payment for those of us who can.
Yeah, and there's a stimulus package coming, that's supposed to help people that lose their jobs, but it looks like it's coming to everybody based on your income from your 2018 tax returns or 2019. There's a calculator that I posted up from Kiplinger that shows exactly how much money you should be getting, and hopefully that'll be enough to cover at least one mortgage payment so that you don't get behind on that if you don't get one of these forbearance programs or don't need it. So that's the thoughts on that.
Moral of the story is save for a rainy day.
Yeah, I think that's one of the things we're going to learn coming out of this. This is the most equity that we've had in homes in our country ever at this point. So back to the refinancing discussion, a lot of people that I'm talking to now are getting, worried that rates are going up or down or whatever, but they've got all this other debt in the background. So now is a great time while rates are low to leverage that equity that you have, pay off other debts, improve your cash flow position, put some money in the bank, and leverage what you have in your home to take out more than you need right now, so that you're set up for any other ups and downs that may come your way.
And within reason, but definitely, pay off what you can, and then don't charge those credit cards up again. I mean,
exactly.
I think there's something to be said for being prepared, with 4 to 6 months living expenses. I mean, if you're in that situation and you have that now, then, you're feeling pretty confident about the near future.
Right.
Yep. So, okay. Well, this is probably a good point to wrap this up. We've covered, what's going on in the crazy markets, and on the finance side, why rates are going up and down, some of those reasons, and an update on the local market showing that it's strong. I think that my outlook is that we're going to see a little bit of a slowdown because people aren't interacting with each other, but it's just pushing off the summer buying season a month or two until people get released from their home.
Yeah, I agree. I've been talking to people, and they're very receptive about having Zoom listing presentations and kind of adapting during this time. So I think that pent-up demand. Hopefully, we are going to see more sellers come on the market in San Joaquin County, and especially here in Mountain House. I mean, we definitely need the inventory. I mean, what good are low rates and willing buyers if they don't have, anything to purchase, right? I mean, we have our new construction here, but we definitely need sellers to, maybe think about moving up or, taking advantage. I mean, now you can get a low rate. So if you had a low rate on the house that you have now, you can kind of still get that low rate and buy something newer, and get something new for yourself and give some more inventory.
But a low rate doesn't do you any good if there's multiple offers on the house and it goes for 40 or 50,000 over. That increases your mortgage payment by few $100s, which is more than it would with a quarter point change in the interest rate. So it's it's all perspective. People get so locked in on what the rate is that they don't see the big picture of what's the overall effect of maybe a low inventory and multiple offers and going over asking. That has a worse effect than the rate that's changing a little bit by 1/8 or 1/4 of a point. So I like your perspective.
Over. You sell the house twice. Once when the buyer buys it, you got to sell the appraiser on it as well. So
exactly, good point. Yeah, it's got to appraise for the bank to give you the loan. So okay, Shelly. All right. Well, thanks for your time today. This has been great. I'll try to do a couple more of these so that we can keep people updated in our local area and spread the knowledge that we have. Hopefully, somebody will get something out of it. Thanks so much for your time.
Sounds good.
Bye-bye.
Bye.